We entered the summer with two main concerns. The first one is Europe, and the second one is China. Finally, the Europeans and the Greeks reach a deal. That is a good news, at least for the short term, even if it's going to be very difficult for the Greeks to implement it. But the Greek crisis is just a symptom of the lack of governance of the Eurozone. And we hope that the Europeans will grasp that opportunity to strengthen the European construction. What is needed is a common budget policy, a common fiscal policy, at least these two elements. Then some debt mutualization would be good. And finally, a system of equalization payments. So what has to be implemented is more solidarity and more governance. And then the continuation of the European project will be ensured. So that's very important. That should allow investors to focus on fundamentals. And as we are expecting a good earnings season, that should allow the European equity markets to continue to go up. China, in the context of a weakening economy, stock market crash is particularly worrying because you could fear that it would spill over to the real estate market, where the Chinese are big investors, and finally to impact domestic consumption. So that's why Chinese authorities were so prompt to do something about it. Nevertheless, we think it's too early to enter the Chinese market, where you can see that the Chinese economy is weakening because the Chinese are a big consumer of commodities, is the commodity complex. We have aggregate commodity indexes at the lowest point for the last 10 years and still falling. So it shows that we still have a lot of overcapacities in place, and it is recommended not to invest in that sector for the time being. It is a secular bear market. So we're going to have rebounds, but sometimes quite strong rebounds, but it's very difficult to make money out of it. It's much easier to be invested in a secular bull market, like, for example, in developed market equities. There, we are still positive, despite the fact that valuations are not cheap anymore and that earnings growth is slowing down. We still have a lot of liquidity there. We have a lot of M&A deals. We have a lot of shares buyback. And we have very, very generous central banks injecting a lot of liquidities into the market, even if the Fed is going to hike rates probably toward the end of the year. Still, we are still living with rates at very low levels. So the situation is quite positive for equity markets, and relative to, and we are here in a secular bull market, so even if your timing is not that good and you enter the market and you suffer a correction, if you're patient enough, you will recover your money and make some money out of it. To finish on a high note, consider the Japanese equity market. Improving fundamentals, strong demand for equities on the stock market, and a very good technical picture. So that could be the best equity markets over the next 12 months.